My apologies for including the image. Here is the revised script, keeping the volume and meaning the same, using simple English and without any headings or subheadings. Most folks assume dividends are a nice gift from a company. They're definitely not. They're actually an admission that the people running the company have run out of good, intelligent ways to use your money, so they are handing it back. And you know what? That is not a sign of failure. It is a sign of being honest. The real mistake is when a top executive saves up cash they cannot use wisely and then calls it some sort of long-term plan. I have witnessed this foolishness for 70 years now. Consider what Warren Buffett has said about Berkshire's approach to this matter. The simple answer is I certainly support dividends in a great many situations, including many of the companies where we own stock. The fundamental question about whether a company should pay dividends is simply whether you can keep creating more than $1 of wealth for every dollar you decide to keep. There are many companies we own that fall into this category. Take See's Candy, a business we fully own. See's Candy has given back almost every dollar they have earned to us because they do not have the ability within the candy business itself to deploy large sums of cash they earn intelligently. So it would be a huge error for See's Candy to hold on to that money. They send the cash to Berkshire, and we then aim to move that capital into some other area where that dollar will increase in value to $1.10 or $1.20 when you look at it in today's terms. This is exactly what I am talking about when I say dividends are an admission. Let me clearly explain what a dividend truly represents. Some supposed genius in a big office decides he is too clever to simply return capital. He plans to build a giant empire. He is going to buy his way to importance. He is going to expand into 17 different sectors he knows nothing about because some hired advisor told him that all these connections exist. Then 10 years later, the stockholders are poorer, and he has moved on to ruin some other business. Dividends stop this kind of corporate sickness. They force a very simple question every 3 months. Do we have a better way to use this dollar than our shareholders do? If the answer is no, then cut the check. If the answer is yes, then you need to prove it with great results. Most managers cannot pass this straightforward test because most managers are not skilled at wisely managing capital. They are just people building empires with fancy spreadsheets. Let me tell you what a dividend really is. It is a report card that is written out in actual cash. When Berkshire gets a dividend check from one of our fully owned businesses, that check is telling me something important. It is saying that we have made more money than we can smartly put back into this particular operation. That is not an issue, it is a benefit. See's Candies has been doing exactly this for 5 decades. Every year See's makes very good profits. Every year those profits are sent back up to Berkshire because See's cannot invest a lot of money in the simple candy business without ruining the solid returns. We have certainly tried to find ways. We have considered expanding, adding variety, and buying other companies. None of it made financial sense. So See's does what smart businesses do. It returns the capital to the main company. Dividends would expose their weakness. That is why they avoid them. Here is a fact that no one seems to want to hear. The decision about whether to pay or not pay a dividend has nothing to do with being friendly to shareholders. It is purely a matter of math. Can you create more than $1 of value for every dollar you hold on to? If the answer is yes, keep it. If the answer is no, send it back. There is no moral issue here. There is no special goodness involved, just simple math. But somehow American business has turned this easy calculation into a big argument. You have people obsessed with growth who think dividends are only for old-fashioned companies. You have dividend fanatics who think any company not paying them is being run by criminals. They are both wrong. The only important question is the return you get on the money the company keeps. Everything else is just distracting noise. I will give you a perfect example of how this plays out in real life. When Charlie Munger and I purchased See's Candies in 1972, we paid $25 million. Over the next 50 years, See's needed almost no extra capital investment. Yet, it made over $2 billion in profits before tax. Almost all of that money came to Berkshire as dividends or as money that acted like dividends. We then took that cash and put it into other businesses and stocks. That initial $25 million purchase has been worth tens of billions to Berkshire. Not because Seas grew rapidly. It did not. It is because Seas knew its limits and gave us the cash to invest somewhere else. That is the true power of managing capital smartly combined with looking at things over a long time. Now compare that to the average company that sells stock to the public. They earn a fair return. Then instead of returning cash they cannot use, they go shopping. They buy rival companies at prices that are too high. They enter related markets they do not understand. They hire outside advisors to approve decisions they have already made. 5 years later, they have wasted billions of shareholder value. But the CEO still gets their bonus because the sales went up. Sales volume is not wealth. Anyone can increase sales by spending money foolishly. The only question is whether you are truly creating value. And the only honest way to measure that is by the return you get on capital and by the decisions made about managing that capital. Dividends force a company to be honest. You cannot fake them. Profits can be adjusted. Future predictions can be changed. Press releases can make things sound good. But cash actually leaving the company, that is real. That is something you can measure. That is honest. When a company decides to pay a dividend, it is making a promise. Every 3 months, we will generate enough cash to pay you this specific amount. If they cannot keep that promise, everyone knows. The dividend is cut, the stock price drops, and the management looks foolish. That need for accountability is valuable. It stops companies from lying to themselves about their future prospects. Some people think that buying back stock is the modern way to return capital, just like a dividend. They are mistaken. Stock buybacks are only a smart idea when your stock is selling for less than its real value. If Berkshire stock is truly worth $200 and it is selling for $150, we should absolutely buy it back. We are essentially paying shareholders $150 and giving them $200 of value in return. That is a good deal for the shareholders who continue to own the stock. But if the stock is selling for $250 and we buy it back, we are destroying value. We are paying $250 for something that is only worth $200. That is not returning capital wisely, that is just wasting it. Yet I constantly see companies buying back stock at crazy high prices year after year. Why? Because the analysts on Wall Street tell them to. Because it makes the earnings per share number look better. Because the CEO's stock options benefit from a higher stock price. None of these are good reasons. They are examples of incentives causing foolish behavior. Dividends do not have this problem. A dividend is just a dividend. You are not paying different prices at different times. You are simply sharing the profits. It is a clean process. It is simple. It is honest. That is why I have always preferred dividends over buybacks when capital needs to be returned. They are much harder to cheat. The feeling people get from dividends is interesting to me. When you own a stock that pays dividends, you regularly receive proof that your investment is working for you. Every 3 months, money shows up in your bank account. That is real. It is tangible. It changes how you think about being an owner. You stop seeing stocks as just pieces of paper to trade quickly. You start seeing them as owning a share in real businesses that generate real money. That change in how you think is very important. It turns you from a speculator into an actual investor. Speculators care about how prices move. Investors care about how the business performs. Dividends make you think like an investor. They make the connection between owning a part of the company and receiving income very clear. Most people never make that change. They buy stocks hoping the price will go up. When it does, they feel smart. When it does not, they feel foolish. Their entire investing experience is guided by price changes and their own feelings. Dividend investors have a different experience. They buy businesses that pay them. Prices go up and down, of course, but the income keeps flowing in over time. That income increases, and that increasing flow of income, not the price going up, becomes the main way they build wealth. Let me explain the power of compounding, because this is where dividends become incredibly powerful. Imagine you invest $10,000 in a stock that pays a 4% yield. The first year you get $400 in dividends. If you reinvest that money, you now own $10,400 worth of stock. The next year, assuming the yield stays the same, you get $416. You reinvest that again. Now you own $10,816. This keeps going year after year. The dividends buy you more shares. Those new shares produce more dividends, which then buy even more shares. After 30 years of doing this, assuming the dividend grows by 6% every year, your original $10,000 has turned into $76,000. But here is the truly amazing part. You are now receiving over $4,000 every year in dividend income. Your return on your original $10,000 investment is over 40%. That is the power of reinvested dividends and simply waiting. Most people cannot understand this because people are terrible at grasping how exponential growth works. It looks very slow at the beginning. The first few years, your dividends barely seem to make a difference. So people get frustrated. They think it is not working. They sell and buy something more exciting. But the patient few who let it compound eventually reach a point where their dividends alone are more than their original investment. That is when you realize you have built something lasting. I have seen this same pattern play out countless times. The impatient people lose, and the patient people win, not because the patient ones are smarter, but because they can handle being bored for a longer time. Dividends reward boredom. They pay you for doing nothing. And in a world where everyone believes they must constantly be doing something, doing nothing is a huge advantage. There's another aspect of dividends that people often miss: stability. A company that consistently pays dividends is less likely to do something disastrously stupid. Why? Because they have promised cash flow to their shareholders. They cannot use that cash for terrible acquisitions or pointless, flashy projects. The dividend acts like a control on spending. It limits the management's ability to waste money. Think about it. If a company pays out 50% of its profits as dividends, the management only has the other 50% to spend. That forces them to decide what is truly important. They have to choose their investments very carefully because the cash they have is limited. Companies that hold on to everything have no such limitations. They can waste money freely, and they usually do. This is why I have always liked companies with regular, steady dividend policies. Not because I need the income myself. I do not. Berkshire does not pay a dividend because we can reinvest the capital internally at high rates without tax complications. But when I see a company paying regular dividends for decades, I know I am dealing with a management team that truly understands financial discipline. They know when to spend and when to return money. That is rare. Now, let us talk about dividend growth, because this is where real wealth is created. A company that pays the same, unchanging dividend forever is okay. But a company that increases its dividend every year, that is a machine for compounding wealth. Consider a company that pays a 3% dividend today, but increases that dividend by 8% every year. In 10 years, your return on your original investment is over 6%. In 20 years, it is 14%. In 30 years, it is 30%. You are getting nearly 1/3 of your initial investment back every single year just from the dividends. And the stock price has likely gone up nicely too, because dividend growth usually follows profit growth. This is how you turn a small investment into a fortune that lasts for generations. You buy good companies that can steadily increase their profits. You reinvest the dividends. You wait for decades. The first 10 years feel like nothing is happening. The second 10 years feel a bit better. The third 10 years feel like a miracle. But you have to make it through those first 20 years. Most people quit. They leave after 3 years because it is too boring. Then they spend the next 30 years wondering why they never became wealthy. The reason is they confuse constant activity with real progress. The best investors I have known were not the busiest ones. They were the most patient. They found good businesses, bought them at fair prices, and held onto them forever. Dividends were the energy that made that strategy work, because holding a stock for 30 years with no sign of results is almost impossible for most people. But holding it while you receive increasing dividends every 3 months, that is sustainable. The income gives you permission to be patient. Let me tell you what dividends have meant to Berkshire over the years. In our early days, we owned stocks like American Express, the Washington Post, and Wells Fargo. These companies paid us significant dividends. We did not spend those dividends. We used them to buy more stocks, more businesses, and more opportunities. Every dollar that came into Berkshire from dividends was put back into the business at high rates of return. Over 50 years, that compounding process created hundreds of billions in value. None of it would have happened if we had only owned fast-growing companies that never paid anything. We needed that cash flow to fuel our capital management machine. Dividends were the fuel. Our patience and smart investing were the engine. Together, they built Berkshire. That is a system anyone can copy on a smaller scale. Buy companies that pay dividends, put the dividends back into the stock. Wait, it is not complex. It is just difficult because it requires you to do nothing for very long periods. And people hate doing nothing. They think inactivity means failure. In investing, inactivity is often the road to success. People often ask me why Berkshire itself does not pay a dividend. The answer is that we do not have to. As long as we can turn $1 of retained profit into more than $1 market value, keeping the money makes perfect sense. The day that stops being true, we will start paying a dividend. It is not about a rigid belief, it is just simple math. But I have noticed something interesting. Most Berkshire shareholders do not actually need dividends from us. They are already getting plenty from our own operating companies. When you own Berkshire stock, you are indirectly owning See's Candies, Nebraska Furniture Mart, Dairy Queen, and many other businesses. Many of these businesses pay dividends to Berkshire. So while you do not get a dividend check directly from Berkshire, the true financial reality is that your ownership share is generating dividend income. It is just being automatically reinvested for you. That is actually better for taxes than receiving the cash and having to invest it yourself. So, Berkshire shareholders get the advantages of dividends without the tax problem. That is a pretty good deal, if you ask me. But it only works because we have earned T. He right to keep the capital by proving we can invest it successfully. If we ever lose that ability, the smart thing would be to start paying dividends. Ego should never be part of the decision. Now, I want to bring up something that bothers me. The financial news treats dividends like they are some kind of generous gift from the management team. They are not. Dividends are your money. You own the company. The profits belong to you. Management is just the temporary manager. When they pay you a dividend, they are not being generous. They are giving back what is yours because they cannot use it better than you can. This way of thinking is important because it changes how you judge the people running the company. You should not be grateful for dividends. You should expect them when they are appropriate, and you should be suspicious when a mature business that makes lots of cash refuses to pay them. What are they hiding? What are they planning to waste money on? Those are the questions you should be asking. I have seen too many investors become obsessed with management teams that talk a lot but never return any cash. They use phrases like reinvesting for the future and building long-term value. But if you look closely, they are just spending money on projects with terrible returns because they enjoy running a large empire. Shareholders would be much better off if the management admitted they had no good ideas and just paid a dividend. But admission requires humility, and humility is very rare in executive offices. Here is a simple test you can use. Look at a company's return on its own equity over the last 10 years. If it is consistently high, they can probably reinvest the money wisely, so let them keep the profits. If it is mediocre or getting worse, they should be paying most of their profits out as dividends. If they are not doing that, ask yourself why. The A. EY have been paying and raising dividends for decades. Do you know what that tells you? It means they have lasting competitive advantages. It means they produce reliable cash. It means the management is disciplined. And it means their shareholders have been quietly getting rich while everyone else was chasing the newest exciting stock. I am not saying you should only own dividend aristocrats, but you should respect what they represent. They are proof that being boring, consistent, and sensible wins over being exciting, unpredictable, and foolish over the long haul. Most people cannot accept this because being boring does not feel like winning. But compounding at 15% for 30 years feels pretty good when you count the money. That is the problem with today's investing culture. It is designed to maximize feelings, not results. People want to feel smart, feel busy, feel like they are constantly doing something. Dividends do not deliver feelings, they deliver cash. And cash, not feelings, is what makes you wealthy. Every time I hear someone say dividends are old-fashioned, I know I am talking to someone who does not understand compounding. Dividends are not old-fashioned. They are timeless. They are the standard way businesses share their profits with their owners. That will never go out of style, any more than breathing will go out of style. What is truly old-fashioned is the idea that you can build wealth just by guessing and speculating. That has been attempted for centuries. It has never worked in a lasting way. The people who get rich and stay rich own assets that produce income, utilities, real estate, established businesses, things that constantly throw off cash year after year without needing genius or luck. Those families live off that income. They do not spend the original money invested, and because they do not touch the principal, the wealth comp ounds and passes to the next generation even larger. That is how you build a financial legacy, not by getting lucky with one big winner, but by hitting small singles for 100 years. Dividends are the small singles of the investment world. Most investors want to hit home runs. They want the 10-bagger, the stock that goes up 10 times its price. And occasionally they will find one, but then they will lose all their profit on the next 3 investments. Meanwhile, the investor who collects dividends quietly builds up wealth through being consistent and patient. After 30 years, the dividend collector is wealthy. The home run hitter is still trying to get even. This is the great irony of investing. The slower you move, the faster you get where you are going. Dividends perfectly show this irony. They feel slow. They are slow. But over decades, they produce results that look like brilliant moves, but were really just patience and discipline. If I could teach young investors one single thing, it would be this. Stop trying to be the cleverest person in the room. Just own good businesses that pay you cash. Reinvest the payments. Wait. That is the entire secret. You do not need to guess when the market will rise or fall. You do not need to pick the next apple. You do not need to trade complex options or use borrowed money. You just need to own quality and wait. But waiting is the most difficult part because it feels like nothing is happening. Your account grows slowly. Your friends are making fast profits on cryptocurrency or hot meme stocks. You feel like you are being foolish. Then 20 years pass and you are financially secure while your friends are still playing the same gambling game. That is when you realize patience was the secret all along. Dividends make patience possible. They give you a positive result while you wait. Without them, holding for decades would be psychologically unbearable for most people. With them, it is almost easy. Let me tell you what true financial freedom really means. It means your income from your investments is more than your living costs. When you reach that point, having a job becomes optional. You are free, and the fastest, most reliable way to reach that point is through dividend income, not just capital gains, not winning the lottery, but dividends, because dividends are predictable. You know roughly what you will receive next quarter. You can plan your life around it. Capital gains are completely unpredictable. You have no idea what your stock will be worth next year. You cannot plan around that uncertainty. Financial freedom requires predictability. Dividends give you that I have met many people who retired early because of dividend income. They did not get lucky. They did not inherit wealth. They simply spent 25 years buying dividend stocks and putting the payments back into the stocks. Eventually, the dividend stream grew large enough to cover all their expenses. Then they simply quit their jobs. They did not need a huge nest egg of millions of dollars. They needed $20,000 or $30,000 a year in predictable dividend income. That is something anyone with discipline can achieve. Most people never do it because they cannot delay enjoying their money now. They want to spend every dollar they earn. But the ones who save and invest, who build a steady stream of dividends over decades, eventually buy their freedom. That is the real offer of dividends. Not just wealth for the sake of having money. Freedom, the power to say no to things you do not want to do. The power to focus on things that interest you, even if they do not pay well. The power to live life on your own terms. Dividends are the cost of freedom, and it is a price anyone can afford if they are willing to. Be patient. When I look at my own life, I see that dividends played a very important part. In my early years as a lawyer, I invested every dollar I could save. Those investments paid dividends. I reinvested those dividends. Over time, my investment income grew steadily. Eventually, it exceeded what I needed to live on. That gave me options. I could take cases I found truly interesting instead of just cases that paid a lot. I could refuse clients I did not like. I had a clear advantage. That freedom, more than the money itself, changed my life. I became the author of my own story instead of just a character in someone else's. Dividends made that possible. So when I tell young people to focus on dividend income, I am not just giving them investment advice. I am giving them life advice. Build a source of income that does not rely on your daily work, that gives you options. And options are the only real wealth that exists. You can measure a person's wealth by counting their options, not by counting their dollars. Dividends create options by generating income that is independent of your time. That is the real goal. Not just to collect big numbers in a bank account, but to collect freedom. And the only way to accumulate freedom is through cash flow that does not require you to be physically present. Dividends are that cash flow. I often say that if you want to know a person's true nature, look at how they manage money. The same is true for companies. You want to know a company's true nature, look at how it manages its dividends. Does it pay them consistently? Does it increase them steadily? Does it keep them going even during hard times? These actions reveal everything about the company. A company that cuts its dividend at the first sign of trouble is telling you that the management panics easily. A company that increases its dividend every year for decades is telling you that the management is capable and confident. Character, in people and in businesses, is fully revealed under pressure. Dividends are a window into that character. The companies that maintain dividends through recessions, through bad industry conditions, through competitive challenges, those are the companies with real underlying strength. They are not faking it. They are generating enough cash to pay shareholders even when times are tough. That is the kind of business I want to own, because if they can pay me during a crisis, they will certainly pay me during good times. And over a lifetime of investing, you will face many crises. The companies that survive them are the ones worth owning. Dividends help you spot those companies before the crisis even begins. In the end, investing is simple. Own assets that produce things. Let them work hard for you. Collect the income. Reinvest it. Wait, that is the whole plan. Dividends are how you collect the income. Without them, you are relying entirely on someone else being willing to pay you more than you paid for the stock. That is speculation. With dividends, you are collecting a share of the actual business profits. That is investing. The difference is huge. Speculators need people who are even more foolish than they are. Investors need profitable businesses. One is just a game, chance. The other is true capitalism. I prefer capitalism, and so do dividends. They are the evidence that capitalism works, that businesses create real value, and that ownership actually means something. Every dividend check is a small reminder that the system is working, that being sensible wins, and that patience is rewarded. In a world full of noise and confusion, dividends are a signal, a pure, clear, honest signal. And if you learn to listen to that signal, to trust it over all the other distractions, you will do just fine. You might even get wealthy, but more importantly, you will be free. And freedom, not wealth, is what we are all truly searching for. There is another thing about dividends that does not get talked about enough. They force you to understand real business economics in a way nothing else can. When you own a stock that pays a dividend, you start thinking about the business completely differently. You ask yourself, where does this cash actually come from? Can they keep generating it? What could stop it? Those questions make you a much better investor. Compare that to owning a fast-growing stock that pays nothing. Your only real question is, will someone pay more for this stock tomorrow? That is not analyzing anything. That is just guessing about what people will feel. With dividends, you are forced to understand the actual business operations. Does it produce cash? Can it keep producing cash? Will that cash flow increase over time? These are concrete questions with clear answers. You are no longer dealing with feelings and hopeful wishes. You are dealing with the basic facts of the business. The change in how you think is priceless. It protects you from silly trends, from bubbles, from the crowd going crazy. Because when your mind is focused on cash generation, you cannot get caught up and talk about revolutionary ideas or new economic models. Oh, here is another truth about dividends. They force companies to run efficiently. When you have to pay out cash every 3 months, you cannot afford excess expenses. You cannot afford waste. You have to run a very lean operation because the cash must be available to pay. Companies that keep all their profits often become inefficient. They have too much cash just sitting around. So they build extravagant new headquarters. They hire too many employees. They lose the discipline that made them successful in the first place. The dividend acts as a strong check on that tendency. It keeps the management focused on efficiency and making cash instead of just building an empire. This is one major reason why dividend-paying companies often perform better over long periods. Not because the dividends themselves create value, but because the discipline needed to pay them consistently actually creates value. It is a mandatory requirement for good management. I have always believed that having limits encourages creativity. When resources are limitless, people become lazy. When they are limited, people become resourceful. A dividend policy is a limit that a company puts on itself. It says, we will return this set amount of cash to shareholders every 3 months, no matter what. That limit forces management to be resourceful, to find smart ways to generate that cash and avoid waste. And over decades, that kind of discipline adds up to significant value. Think about it simply. 2 companies make the exact same profit. One keeps all the money, the other pays out half as dividends. The one that keeps everything has twice as much money to use. You would expect they would create more value, but often they do not, because having too much money makes you sloppy. You make acquisitions you should not make. You invest in projects that only offer marginal returns. You lose your focus, the compa. And why paying the dividend